Hey everybody, Steve here with IBC Global. Hope the day is off to a great start. In today's video, we are going to answer a question that comes up sometimes, which is, can I copy what banks do with cash value life insurance products? And the short answer is no. We're going to go through what banks do, how you can mimic them as closely as possible. But this video will provide a lot of details that I don't think a lot of people are aware of. So let's have some fun. So when it comes to banks and cash value life insurance, it is no secret anymore that banks put a ton of money in cash value life insurance products. If you were to look at some of the larger banks in the United States that people recognize immediately, like Bank of America, Wells Fargo, you'll see in the cash value holdings alone of their life insurance products, they've got over $20 billion. So 20 billion with a B sitting in the cash value holdings, and they continue to purchase more bank-owned life insurance. So they continue to do that because it's an attractive area. They can position money, looks good on their balance sheet. It also provides a long-term benefit with the life insurance payout that comes back to the bank. We'll go through exactly how it works when we break down the details. But the question that people sometimes have is they think, okay, why are banks putting money in life insurance? First, tell me that. And then if I can copy what banks do, I'd like to do that with cash value life insurance. There must be something beneficial there if the banks are doing it because they've got a lot of capital. And really, how do I copy what they do so I can control my own financial situation and not have to rely on banks? So let's go through exactly what bank-owned life insurance is and how it works and how it does not work. So to begin, when we look at the actual product, bank-owned life insurance, it is a single premium universal life insurance policy. It is not whole life insurance. Now, what I will say here, this is where confusion sometimes arises, is when you look at the major mutual companies, right? Your four major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual. If you take two of those, Mass Mutual and New York Life, they have for a long time been the leaders in the BOLI space. Northwestern Mutual has a very attractive bank-owned life insurance product as well. And when you look at Guardian, they've got a product that's more favorable for smaller community banks. That's really what it's geared toward, very attractive. But my point is, those four major mutual companies are carriers that their core product that they offer to you and I, individuals, is whole life insurance. That's their product. That's what they're very good at. However, when they break into the corporate market or to working with banks, they do offer a very attractive BOLI product, bank-owned life insurance, which is not whole life insurance. It is a single premium universal life insurance policy. Now, if it's a single premium policy, that would indicate it is a MEC. And it is a MEC. It's a modified endowment contract. And what a modified endowment contract is, how that works when we look at the cash value, is the cash value grows tax deferred. If we want to access it, we have to pay income tax on the gains and potential penalties. So the question that I have, and let me know if you ever heard this, is do banks access the cash value in their life insurance policies? Specifically, do banks borrow against their life insurance policies, take that cash value and lend it to you and I while the money in the cash value life insurance product continues to compound? The answer is no. They do not do that at all. So we'll hit more on that as we progress through things. But why do banks purchase cash value life insurance? Number one, it's a tier one asset, meaning it's the safest capital on their balance sheet. Very attractive area that can position money that carries really no risk. There are different types of bank-owned life insurance products or accounts they can allocate the funds toward. The most common is what is referred to as general account BOLI, which means when the bank makes a purchase, they are participating in the insurance company's general account. So they're just with the life insurance carrier, wherever the insurance company is investing, they're participating with that investment, or those investments, I should say, but they're participating in their general account. Then you'll have separate account BOLI, which has to do with the stock market. And then you'll have a hybrid account BOLI, which is a combination of funds in the general account and some funds in the market. So you can, as a bank, if you own a bank, you can set it up to be a variable product and have a bit more upside potential. Most banks don't do that, at least through my experience. I've not seen that in the bank we work with. purely goes with general account BOLI, very, very safe. So the why, tier one asset, looks good on the balance sheet, safe, grows tax deferred because it's a MEC. So if they never touch the cash value, they do not have to deal with taxes. The death benefit is paid out income tax free. And then cost recovery. I'm going to hit on this. I'll hit on it right now, actually. So when it comes to cost recovery, banks have a lot of expenses. They've got employees, which they offer health insurance, 401k matches, and several other benefits too. That's all a cost. So what BOLI provides for a bank is, say you're an employee of a bank. Let's say you own a bank and I'm your employee. Let's do it that way. You're spending 10 grand per year on all of my benefits, and those benefit costs to you gradually increase over time. Like everything else in the world, the cost keeps going up. So you continue to dish out those costs for me, your employee. And when I eventually die, you do have this BOLI, this bank-owned life insurance policy on me, your employee. The death benefit flows back to you, the bank, completely income tax-free. That's how you recover your costs. So when I say cost recovery, and that's a reason why banks purchase BOLI from a long-term perspective, that's what they're doing. And they will take these products out on their executives and their employees. Sometimes we hear that they only take policies out on their executives. They typically start there with their executives and officers, but there's no restrictions there. The employees do need to consent anytime the bank actually takes a policy out on them. A lot of times it's multiple policies, but it's not just on executives in the majority of cases, I should say. And again, that death benefit is paid out income tax free. Now, here's something which we hit on already. Do banks borrow against their policies? Meaning, is bank-owned life insurance liquid? The answer is no. It's a MEC. When you look at the cost to borrow, the loan interest rate on bank-owned life insurance products, they're higher than whole life products. There's really discouragement there to take a loan against the policy, and banks don't do that at all. It does not make sense, and that's not why they purchased the product either. So with that said, can you do what banks do? Can you get a bank-owned life insurance policy? The answer is no. A bank-owned life insurance product is available only to banks. Can banks purchase and own pure whole life insurance? How about that? The answer is no. Unless they set it up where a trust is the owner, they get creative there. That's really the only way. If a bank wants to take out cash value life insurance products, pure whole life insurance products in which they can actually access the cash value, that is often a no-no from a regulation standpoint. And there have been cases where that's been a bit of a mess, where the transactions had to be reversed because they can't do it from a regulation standpoint. They're limited to bank-owned life insurance only. Pretty interesting, isn't it? So can you do something similar to what banks do? Yes, when we just look at the nature of cash value life insurance. Before we get into the next section, let's actually look at some bank-owned life insurance policies, or illustrations, I should say. So what I'll start with is an illustration we considered when we were working with a bank that we set up the BOLI policies for. So where we get our information from is firsthand working with a bank. So we work with one bank, we work with banks, but we only have one that we work with that is a client that has set up their BOLI policies with our company listed as the agent. So that's where we get all of this information from. So as we continue on here is a single premium universal life insurance policy, $10 million deposit. This is one illustration with one company. And what we've got here are the guaranteed values and then the non-guaranteed values. There's your cash value based on the guarantees, and there's the non-guarantees. Just like a whole life insurance product or any product, this is something that is reviewed on a regular basis. With banks, there's a third-party administrator involved that will send monthly reports to the bank and the broker or agent on record. And the monthly reports display the cash value and death benefit values. So you can actually track it month over month. You don't have to. I mean, it's pretty straightforward, but at the same time, you are provided with that information, and it's provided by a TPA, third-party administrator, not the agent or broker. There has to be third-party administrator involvement as well with bank-owned life insurance. It's a bit different where I can't just walk into a bank and sell a policy. It's a much more complex process. So non-guaranteed values on the right, and this is something we track over time. The third-party administrator does, but we want to track the performance as well. And typically, a BOLI purchase is broken up among a number of insurance carriers because there's limits as to how much life insurance a bank can purchase, how much money a bank can deposit with each life insurance company is how I should phrase it. For example, the bank we worked with was capped out at only being able to pay in about $7 million per life insurance company. They wanted to deposit more than that, so we had to split it up among a number of companies. So we'll look at the example. But before we do that, so this shows the values and just the appreciation over time. But let me go up here. So a couple points we'll see here. One, you'll see this every single time. So there's the MEC, modified endowment contract, because it's a MEC. Another thing that's very interesting is if we were to look at a whole life insurance carrier product with this carrier, we'd see a loan rate between 3 to 5%, really. Now it won't be 3% because interest rates are higher right now, but floors of 3% with whole life insurance products. With this, what do we see? A fixed loan interest rate at 8%. So do banks borrow against cash value life insurance products, their BOLI products, and then lend it out to you and me? No, they don't do that at all. The cost to borrow is higher than what they're earning on the product, and it's a MEC. They'd have to deal with taxes if they do that. Why they purchase these products is, again, it's a tier 1 asset, looks fantastic on the balance sheet, continues to appreciate over time. The death benefit does flow back to the company, to the bank upon each employee's death. In this particular case, with this $10 million deposit, this is an illustration on, it was 27 or it might be 30 officers. This was for the bank that we work with. So when you look at the full illustration here, you'll actually see this $10 million broken up among 30 different people. And depending on the age and gender of each person, the performance will vary a little bit, which is interesting. But point is we do not have access to it, or banks do not have access to it. So let's look at one more example. Here we go. This actually displays a purchase, 2 purchases in 2020 and 2021 that a bank made. And here's how it was broken up. So we see 2 $10 million deposits broken up between different insurance carriers. 10 million, 10 million, total of 20. There's the asset on the balance sheet, total death benefit among all employees. The very attractive part that some people have asked is, well, can I get a product that has positive cash value day one, a whole life insurance product? Is that possible? No, you can get very, very close to that, and you can mimic what corporations do, but not with this. We can't get a BOLI, a bank-owned life insurance product, unless you own a bank. Then it's a different story, obviously. So can you do something similar? Well, small businesses and corporations. If we start with corporations, corporations cannot purchase bank-owned life insurance. However, they can purchase what is referred to as COLI, which is corporate-owned life insurance. And here I've got pure COLI and then whole life that's considered COLI. So pure COLI product, I made up the term pure COLI. There's a COLI product which functions a lot like a BOLI product, which is a one-time lump sum deposit. That's typically a variable universal life insurance policy. But then you've got corporate-owned life insurance, and you'll see this with small businesses and corporations, where you've got whole life insurance products that are owned, that are purchased and owned by a business or a corporation. And it's considered corporate-owned life insurance because it's a life insurance policy that a corporation owns. However, they are different products. A whole life insurance product that a corporation purchases or a small business purchases is the same thing that you and I can obtain as an individual. Whereas a pure COLI product, like a pure BOLI product, I wouldn't be able to get that as an individual. Some of them you can when you look at pure COLI, but my point is A whole life insurance product that is owned by a small business is sometimes called COLI, corporate-owned life insurance, and some call it EOLI, employer-owned life insurance, all these different terms, right? You got to have fun with it. But my point to this is whole life insurance products are used. Now, why are they used among corporations? Similar to why banks use them. It's a safe area to position money, meaning it's not tied to the stock market at all. As time passes, the net internal rate of return, net growth rate, is probably going to fall somewhere in this neighborhood based on past performance and shooting things a bit more conservative. If we were to look at history, you'd see a lot of products fall in the 4 to 6% range. However, those lived through a very high interest rate period. Interest rates are lower right now, even though they've started to come up for a little bit. It would require a long duration of increased interest rates for me to confidently feel that it could be closer to the 4 to 6% range. I'd rather shoot it more conservative. So safe, that 3 to 5% is consistent if things are going very, very well in the stock market and economy, or if things are going very, very poorly. With that said, remember, it is negative in the early years of a policy. It's going to take a couple of years before it breaks even. We're going to look at a corporate policies shortly here. Liquid. So this is a big difference between small businesses and corporations that take out whole life insurance products and banks. Banks' products are not liquid. They're not purchasing them for the liquidity. A pure whole life insurance product is liquid. That's where I can access the money like a personal line of credit as the cash value continues to appreciate over time. So I can access it anytime I want, very easy to get to through the loan feature. We talk about that a lot. Then tax-free. So the definition of cash value buildup in a life insurance policy is that it grows tax deferred. However, you can access it tax-free if you do things properly, meaning we don't trigger a modified endowment contract. If we don't take out the maximum loans, then the policy lapses where I've got a gain on it and I've got a taxable event if I avoid a taxable event. So important to provide education on this, which we've got other videos that do this, only because where people have issues with whole life insurance or any product is when expectations are not set properly up front, or we find out something after the fact, like I was told it's tax-free. Now, all of a sudden, I've got a taxable event other than a MEC. Wait a minute, this wasn't supposed to happen. Well, the definition of life insurance, when you look at what can trigger a taxable event, if it lapses with a gain on it, well, now you've got to pay income tax on the gains. Like, what? I didn't know that. We don't want that. So anyway, my point is tax-free if we do things properly. Now, on the corporate side and small business owner side, golden handcuffs, retain and reward. So this is a strategy that a lot of companies use, and they're really creating a retirement benefit for their employees. And with that retirement benefit, what you'll see happen, how that works, is companies will take out policies on their executives, typically executives, it can be anyone, but they'll take a policy out on their executives and basically say, if you stay with me for the required vesting period that I, the company, put in place, I'm going to pay you a retirement benefit from the age of 65 to 85, or really whatever the company wants to do when they set the terms of that agreement. However, if you leave Mr. or Mrs. Employee, you do not get that retirement benefit. So what it does is create a retention strategy where employees feel like, okay, I'm going to stay with this company for the long haul. This way I get this reward on the back end of this retirement benefit. Great. And there's a lot more that goes into it, but you'll see whole life insurance products often used for that based on the guarantees. When we look at the income payout in the back end, we are shooting things very conservative and also making sure that there's a cost recovery aspect for the corporation, because that employee or executive is going to kick the bucket at some point in time, and we want to make sure a death benefit comes back. And then on the funding, it is very flexible, but here we've got long-term or short-term. So banks, from a funding perspective, it's a short-term deal. They make a deposit, that's it. If they want more bank-owned life insurance, they make another one-time deposit. Depending on where interest rates are, you will sometimes see them borrow from the Fed at a very, very low rate and stuff it into a cash-free life insurance policy. Most of us do not have that opportunity. But with corporations and individuals do the same thing here. Fund a policy for a long period of time or short period of time. It's flexible. you can do whatever you want. And I would consider different options. It's 100% up to you. I have seen a lot of people prefer the short-term funding scenarios. This way, they don't feel like they're obligated to make payments for a long time, where they just like the idea of getting a chunk of money from their bank account or another source into a policy, letting it ride, and then they can access it like a personal line of credit as it's guaranteed to continue to appreciate over time. So, hope this helped as far as providing more information on bank-owned life insurance. And if we can get it as an individual, the answer is no. However, we can obtain cash value life insurance products that are very similar to that. What we'll look at in our next video is a sample of this, which is a small business that has 5 employees, and they're looking to fund the policies, each policy on each employee at $50,000 per year for 10 or maybe 15 years. And here we go. We've got the funding at $250 per year total. They're only committed to about $25,000 per year. And there's the first year cash value. There's the difference between what small businesses do with cash value life insurance, and individuals for that matter, and banks. The first year cash value, the trade-off, however, the bank is not accessing the cash value. Whereas with this, we've minimized the expenses as much as we could to beef that cash value up. We've got access to it. There's the break-even point. We've got more money in cash value than what we've paid in, and we can stop after 10 years. We can stop after 5 years if we wanted to. In this case, you wanted to see 10 and 15 years, but we're going to look at a 10-year fund and then the same thing with funding it for another 5 years. Hope you enjoyed this video. If you have any questions or comments, please leave them below. If you have any requests you'd like to see regarding case studies, leave them below in the comments. I do look at those. And if you enjoyed, please hit the like button, subscribe for more, and we'll talk to you soon. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.